This is Shweta from ClearTax, and today I will speak about tax implications in case of buyback of shares of a listed company. A buyback of shares refers to a purchase of shares from the existing shareholders, and the same is done to reduce the paid up share capital of the company. The company makes an offer for buyback to the existing shareholders. The company normally issues a letter offering a buyback of the existing shares to the shareholders. The offer letter specifies number of shares entitled to the buyback, the date of opening and closing of the offer for buyback, the price of the buyback, and the terms and conditions for the buyback. A listed company normally communicates with its registered shareholders through the email which is registered with them or by sending a postal communication to the shareholder. The shareholder should peruse the email or the communication before accepting the terms of the buyback and tendering their shares in the buyback. Let us discuss the tax implications in case of a buyback. The company which carries out the buyback is liable to pay additional corporate income tax on the buyback. The tax is levied at 20% plus 12% surcharge on the distributed income by the company. The distributed income is the amount which is calculated based on the buyback price offered by the company as reduced by the face value of the shares. In the case of a listed entity carrying out a buyback, the face value of the share will be the issue price of the share. While the company pays the tax by way of additional income tax, the capital gains of the shareholder will be totally tax exempt. Any gains made by the shareholder, whether they are long-term gains or whether they are short-term gains, the same will be exempt once the shares are tendered in a buyback offer. Let us understand the buyback of shares by a listed company by way of an example. In our example, a listed company announced a buyback at Rs 500. The face value of the shares is Rs 10. The tax will be on Rs 490, which is payable to the shareholder. As we discussed, the tax will be calculated on the buyback price as reduced by the face value or the issue price. So in this example, it is 500 minus 10, that is Rs 490, on which the additional income tax will be paid by the company. The company has to pay 110 rupees per share towards its additional income tax liability, calculated at 22.4% of Rs 490. Rs 490 in our example stands for the distributed income by the company. The shareholder will receive the net amount, that is Rs 500 minus Rs 110 from the company. The shareholder will receive Rs 390. So let us consider if the shares were bought originally for Rs 250 per share, then what will be the net capital gain for a shareholder? It will be Rs 390 minus the original investment of Rs 250. It will be Rs 140 per share. The gain may be short-term or long-term depending on the holding period of the shareholder. In case of a listed entity, the holding period is 1 year for a short-term gain and anything above 1 year is a long-term gain. So as we discussed, the shareholder will not be liable to pay any capital gains tax on the gains made by him. In our example, the gain is Rs 140 per share and the gain is totally tax exempt. However, in this method, in case the shareholder has any other type of capital losses from any other investment during the financial year, they cannot set off the same against an exempt capital gain. So in our example where he earns exempt capital gains and if he has losses from the sale of mutual fund units in another situation for the same financial year, he cannot set off the capital losses against the gains made by way of tendering shares in a buyback. Let us compare tendering of shares in a buyback to shareholders selling the shares on the stock exchange. In case the shareholder makes a short-term capital gain, the shareholder has to pay tax at 15.6%. In case the shareholder has long-term capital gains, the shareholder has to pay tax at 10.4%. The rates are calculated inclusive of education cess, but excluding surcharge. Surcharge is payable depending on the income of the shareholder. However, in case of long-term capital gains, the gains up to Rs 1 lakh will be tax exempt. In case where the shareholder sells the shares to the stock exchange, in contrast to a buyback, the tax is payable by the shareholder on the gain. Also, the shareholder will have the benefit of setting off any other capital loss which he has of the same financial year, or if the shareholder has any brought forward loss from the previous years, the shareholder can set off such losses against the gains. While setting off loss, the shareholder should note that a short-term capital loss can be set off against both short-term gains and long-term capital gains. However, if there is a long-term capital loss, the same can be set off only against long-term capital gain. The following points should be kept in mind while tendering your shares in a buyback offer. From a shareholder's perspective, the shareholder should consider the purchase price paid for the shares by way of an investment, what is the net amount that the shareholder will receive under the buyback offer, the capital gains tax in case the shareholder sells the shares in a stock exchange instead of tendering the shares in a buyback, the capital loss, if any, available to the shareholder for setting off in case of a sale through a stock exchange. Following these steps will help the shareholder in assessing whether it is beneficial from a tax perspective to offer shares in a buyback or sell the shares in the stock exchange. That's all for today. Do like and share our videos and do subscribe to our channel. Thank you.